This Pitch Breakfast video is brought to you by Spangler & Agins, attorneys for Charlotte's startup community.
Thank you. Those are some tough acts to follow, but I'll do my best. I'm going to talk to you a little bit about capital markets and exposure and collateral. So I'm usually a big hit at parties, real exciting stuff. But I'm very much exposed up here, so I think you can all relate. So just to set the stage, there is a huge collateral supply and demand problem in capital markets. It's massive. In fact, estimates are as much as a $2 trillion shortfall in available collateral. And the reason is, if you're old like me, after 2008, 2009, there were some new collateral requirements that came out that said that you had to set aside collateral against your exposures, against your credit exposures. And what that did was, obviously increase demand. And then on the backside of that as well, is there were some new regulations as well that further caused the market to constrain. So to address the problem, we're building the Airbnb of collateral and bringing the shared economy to capital markets. So think of it this way. On one hand, you have banks in need of lower cost collateral. The spreads on some of this collateral now are as much as 450%. And then on the other hand, you've got potentially insurance companies, state agencies, or pension funds that have collateral to spare that could rent that to banks to help them create balance sheet space at a substantially lower cost. So, we did our first trade with a French bank, saved them $2.2 million through a rental with an insurance carrier. Our goal is to generate $1 billion in rentals. We need $250,000 in terms of product and technology development to make that happen. So, thank you.
Well, Chris, you just met with the 2-minute reality, right?
Right.
Yeah, you certainly have one of the harder ones to try and shove into 2 minutes.
Sure.
I consider myself a relatively sophisticated finance guy, and I was wishing that you better explained what the problem was. You used the term collateral, and I think because it's so, and we fall victim to this ourselves, and one of the guys who's often here with me, Chris Halligan, kind of beat it out of Lister and me. It's this phenomenon where the closer you are to a subject, right, the faster you tend to lose anyone else.
Right.
And so you have to force yourself to elevate up to a level that doesn't seem necessary. I mean, I generally understand what collateral is, but it wasn't until the very end of that 2 minutes that it was clear to me what you're talking about is collateral for banks, right, to hold on their balance sheets such that they can then increase their loan portfolio. Is that correct?
That's
basically?
Correct.
And so they're going out and renting this collateral. Mm-hmm. I mean, I guess to me the analogy, it's almost like where you borrow shares to sell short in a way. It's the same type of phenomenon.
Yeah.
So I get it. That's a tough thing to squeeze into a 2-minute pitch.
Sure.
But I would work on it, and I would also, because it's it probably also would have helped to just somehow work in a little bit about you and why you know anything about this space. Why don't you tell us a little bit about
I've been working
and why you know why?
There's this thing called the collateral value adjustment, or CVA. And So I've been working with the CVA desks for some of the nation's largest banks for the past 8 years. And in fact, our name, we make the A part, or the adjustment part, go away. If you post collateral against your exposures, then you don't have any CVA impact. And so I've been helping banks, do that from a reg reporting standpoint for the past 7 or 8 years.
So I think, I'm trying to think about how you can boil this down, right, to some nuggets. And I think the fact that you've made a trade and you saved a bank over $2 million in one trade, that's a pretty big deal, right?
Sure.
So you want to squeeze that in somehow. How do you make money? So if you're saving a bank $2 million on a trade, what do you get? What's your rake?
Yeah, so very similar to the Airbnb model. We charge a subscription. So it's a SaaS model in addition. So there's a recurring revenue model, and then we charge a service fee for any rentals that are done through the platform. So we're not a trading platform, we're a rental. Just swipe left if we can save you some money, type of thing.
So you might want to think about how you can, again, crystallize down to, and you had it in, this $2 billion collateral shortfall in capital markets, but I think you maybe want to take that one step further, and what's the impact of that, right? Because just saying that, that doesn't necessarily mean anything to me as to what's the impact. Does that mean, banks are forgoing $2 trillion in revenue by having that, or so what does that mean? What are the ramifications of that? If you solve that problem, how much more revenue would a bank be able to generate?
Yeah, so to give you an example, that's a great question. Wells Fargo, and it's pretty much consistent. So the way that they're solving that now is they're
opening lots of bank accounts for other people?
No, they're reserving for it. So Wells Fargo's Tier 1 capital, which is the money that they have to keep liquid on a rainy day, is at 14%. So to just give you an example, somebody like Goldman is around 2%. So that's bottom line dollars that they just have to set aside, that they have to keep liquid against these exposures. So if we reduce that number by, in the case of Wells Fargo, by 5%, that's over $5 billion. That goes right to their bottom line that they can use in terms of capacity. So there's soft costs in terms of opportunity, but there's hard dollar savings as well. So.
Yeah, I would agree. You got a tough topic to explain in 2 minutes, but think about this. You know more about this product than most of us 10 times, right? So if you can come out with a simple explanation, maybe an analogy that has nothing to do with financial, that's going to get me engaged in the very beginning.
Right.
And maybe we can sit down afterwards and we can come up with something that's an analogy, because an Airbnb makes me think I'm going to stay somewhere, but really you're renting collateral. Right. And explaining very importantly why it is important, because it is a huge issue, right? And so finding a way to explain that, and that's going to eat up a lot of time during 2 minutes, but I think it'll be important for a general audience like this, or an investor who's not as financially savvy as John. Even to that point, as I was listening to you, and I know your product from talking to you before, but I didn't hear until probably about a minute in that companies are your customer. Sure. And you just followed two consumer companies. So I think a lot of people were probably thinking, how's this going to help me? Is this a collateral for me to get a loan versus a company? And talking about the market size, you're dealing in a huge market with a lot of numbers, and you don't need a lot of market share, and your product's pretty innovative. So if you can maybe lay that trail of make it simple, give us a hook to get in, talk to us about market size, it might be helpful.
Yeah.
Because you've got something really cool.
Yeah.
You've just got to explain it.
Right. Yeah. Well, thanks, Keith. Yeah.
Anything else from the panel?
Out of curiosity, why do you think no one else is doing this? What's kind of got to be involved to make this work?
So, well, there are these things called liquidity hubs. I think Dan's here somewhere. The analogy that I use in the capital markets, which I haven't really figured out a better one, is it's sort of like the repo market, where I give you collateral and you take it back. But there are these things called liquidity hubs, where if I've got a shortfall, bank can call them up, and they're essentially dealers, you know, and so they're providing that service, you know, with a markup. You know, our two big ideas is we've got some core IP that does what we call a look ahead. It's an algo that'll sort of plot by quarter end what the shortfall is going to be for the bank. And then we've actually gone to outside market participants, those that don't really, you know, haven't played traditionally on the field, like a state agency or an insurance company. You know, so they're just calling around to, you know, other banks, you know, doing a markup, other commercial banks or what have you that aren't subject necessarily to, you know, to the requirements. So that sort of thing.
So this is a marketplace of sorts.
It already is a marketplace. You know, it's incredibly inefficient. I've got this really messy diagram. You know, you can just see kind of all the hops that it goes to, and you know, we just want to cut out the go-betweens. So there's already about a 15 basis point spread in there. You know, so and then we knew that there was a supply problem, so we wanted to add to the supply chain, and as well as give the bank sort of a look forward relative to what they can expect to save, you know, kind of turn it around and match it up with market pricing. So,
Yeah, you might want to work on how, because it wasn't entirely clear to me that it should have been, but this is a marketplace, and so you've got to have both the supply and the demand on there.
yeah, it's a $200 trillion in collateral just in the States rolls every day. So, and among that, there's about a $2 trillion shortfall on any given day.
Yeah.
So, you know, as Keith said, we want kind of a really small slice of that. So our first trade was 22 million. So these are going to tend to be large deals.
Yeah.
Yeah.
Sure.
So Chris, we talked about this the other day. It's almost impossible to explain what you do in a 2-minute pitch or 5-minute pitch, let alone a 2-minute pitch.
Yeah.
I think an illustrative example behind you that shows the trade that you actually did. So show the foreign bank on one side and it shows the insurance company on the other, and exactly how the money moves and how it works.
Right.
Picture's worth 1,000 words. I think that would just augment your short pitch.
Agreed. Yeah.
If I'm understanding what you're saying, how is this unwound? Because if the institution is renting the collateral to shore up their balance sheet, the rental period is going to end at some point.
Sure.
And their balance sheet's not going to be as strong.
Right.
Is this a long-term lease? Like how?
Yeah.
How does it unwind?
Our first deal was 3 months. You know, we spent a lot of time and money on what's known as an ISDA, but it's essentially our master services agreement. And that's not automated yet. That's some of what we want the money to do. So it would sort of populate that with the T's and C's, and they would negotiate, and then it would send it off to internal counsel. But the ISDA framework is sort of the legal framework that supports the collateral marketplace now. So we're just kind of riding on those existing rails. The last thing we wanted to do was create a new asset class or make new law. You know, as somebody that used to work in government affairs, we just want to stay away from that. So we as much as possible, we tried to sort of leverage the current legal framework. But we do a couple things to answer your question directly. We make the bank, as part of our rental agreement, we actually purchase protection in the event that the bank doesn't make the payments. So the investor's covered, you know, for that rental term. And then our agreement, our master services agreement, actually puts the collateral renter in first position. So in terms of the waterfall, you know, if the bank, we only work with A-rated banks. If the bank were not to make its payments, our renter's in first position, you know. So and we go out just like PMI in the mortgage industry. We go out and we actually buy, you know, payment protection from a carrier as part of the deal.
That's for the term, like during the rental term.
Sure.
That's how the risk is sort of.
Yeah, we're transferring that.
When the term is over, I guess what happens to the.
They give the collateral back.
Right, and so then their balance sheet is the institution's balance sheet is weaker because they don't have that collateral.
Well, yeah, I mean, you have to understand they're funding, they're funding, if you think of collateral in terms of inventory, we're helping them better manage their inventory, right? So,
Okay.
so I've got all this in,
inventories,
yeah, I've got all this inventory that's rolling daily, so.
And I'm sorry, I'll invite you guys to continue that conversation right after this. We're going to meet on this company, Chris with.
Well, I really appreciate it.
Short-term paper. We're using short-term paper to finance